The top business stories live from the Sky News City studio. Wages grow ahead of inflation for the 10th consecutive month, but unemployment has also edged higher. The White House announces plans to hike tariffs on Chinese electrical vehicles from 25 to 100%. Plus, the FTSE 100 mining giant Anglo American is to break itself up in the wake of a £34 billion takeover approach. Good morning, this is Business Live with me, Ian King. Wages grew more strongly than expected again last month. The Office for National Statistics said regular wages in the 3 months to the end of March were up 6% on the same period last year. That was unchanged from the 3 months to the end of February and was slightly stronger than the 5.9% growth that had been expected. It means regular earnings have now been growing more strongly than the headline rate of inflation for the 10th consecutive month. Public sector pay grew by 6.3% during the period, while private sector pay was up by 5.9%. The ONS also reported that the unemployment rate rose to 4.3% during the period, up from 4.2% during the previous 3 months. The number of job vacancies in the economy, meanwhile, fell by 26,000 to 898,000 during the period, which was the 22nd consecutive month in which the number of vacancies has fallen. Well, with me now is Victoria Clark. She's UK Chief Economist at Santander Corporate Investment Bank. Victoria, great to see you this morning. Why is wage inflation proving so sticky?
Well, one of the things about wage inflation is that it does seem to reflect what happened in the past. And so, there is an element of this reflecting how tight the UK jobs market has been and how high inflation's been. And, all of that takes a while to feed through into wage negotiations and come down. But the other element is that we have had another big increase in the national living wage this year, nearly 10%. And I think what you're probably seeing in some of these figures is firms front-loading some of those increases in a very similar way to the picture that we saw last year. And so it does seem as if that national living wage increase is also lifting the numbers. That's
very interesting, because, of course, that didn't kick in this period. It only began in the beginning of April.
It did. So the increase took effect at the beginning of April. But this year, as last year, we did see some chunky increases in pay in February and in March. And if you look back at the pay picture from a year ago and you compare it to the picture that we're getting today, they are eerily similar. We looked at a 0.9% monthly rise in February last year and then about 0.4% in the month that followed. And this year, it's a similar picture. It's about 0.9 and then actually nearer 0.6 on the month. So this is fairly robust pay increases, showing that living wage effect and showing, well, seemingly, that the tight to loosening jobs market is not really bringing the numbers down.
And that's really, really odd. I mean, that's not how it's supposed to work, is it? I mean, unemployment's going up, vacancies are falling. Under those circumstances, you'd expect to see wage inflation coming off the boil.
There is a question about really what's going on with the labour market beneath the surface, because one of the big issues here is that the unemployment numbers come from this survey, the Labour Force survey, which has had various issues, low response rates being the main one, and has led a lot of us, including the Bank of England, to question whether these numbers can really be trusted. So unemployment's gone up. It's not gone up in all measures. The claimant count has been really super steady, actually, at 4.1%. And other metrics of the looseness or tightness of the labour market, like vacancies, have been coming down. But perhaps even those might be leading us astray if it doesn't cost as much to leave a vacancy up there on the internet as it did before. I think probably the jobs market is softening, but not, perhaps as much as the headline unemployment rate would suggest. And all in all, it's a bit muddy and may explain partly why, wages have been stickier if the jobs market isn't quite as loose as the numbers would suggest.
Yeah, and all of this, of course, a huge conundrum for the Monetary Policy Committee.
Absolutely. So they're left trying to work out, what to do with interest rates with these questions about the data, which are big. The bit of the data that doesn't come from this labour force survey, the part with questions, is the pay data, the average weekly earnings, and they are the strong bit. So you would think that they would say, look, let's focus on the pay numbers. That's a bit of a warning sign that that's not going to take them on a path where they're consistently back to their 2% inflation goal. But really what they seem to be saying at the moment is, look, it's OK if pay growth is quite robust, providing that's not passed through to prices. And that's the thing that they're really focused on. And I think if they get reassurance on that, they seem quite keen to cut rates.
Yeah, and we heard from Hugh Pill, of course, the bank's chief economist. What's he been saying today?
So Hugh Pill's been towing quite a sort of balanced line. I think he is probably more worried than most on the MPC about the fact that we're not quite there with the pay picture, that it is quite sticky. But also, you know, he wants to note that we've got the progress on inflation. Inflation's coming down. He is, though, you know, anxious about whether we're going to get inflation sustainably down. And so he's a little bit more hawkish than the rest of the MPC and hasn't really, you know, green-lighted the rate cuts for June, but also, you know, wants to keep everything in play. Now, I think the key thing for him is going to be the inflation numbers, which are going to be coming up next week. Particularly services inflation and this question of pass-through to prices. So, look, he probably, like the rest of us, are waiting to see all these key figures, and so don't pin your colours to the mast until you see that. Yeah,
OK. Victoria, good to see you as ever. Thanks for joining me. Now, the White House has just announced that tariffs on Chinese electric vehicles will rise from 25% to 100%, ostensibly to protect the US industry from cheaper imports. Tariffs on batteries, solar cells and certain critical minerals are also being hiked. Our economics editor, Ed Conway, is with me. Ed, pretty protectionist stuff, this, from Joe Biden's administration.
It is, in a sense, it kind of continues what the Trump White House was already doing. So the Trump White House raised tariffs on a variety of different Chinese goods up to about 25% in the case of cars. And this has amplified that. And I think for a lot of people who are looking at the Biden White House and maybe who had convinced themselves that it would have been different to China when it came to its economic policy, well, no, actually, in many senses, and this is not really the first instance, this is just the latest, in many senses, the Biden White House has doubled down on this. You've got new subsidies that are supposed to help American industry in much the same way as Chinese industry had lots of subsidies to try and build up their electric car sector. But there's a broader message here, which is the White House is determined, I guess, first of all, to try to win out in this race to build all of these machines of the future. You know, we are at the outset of what some might call an industrial revolution, and you've got to have to do a lot of building. But I think the second thing to bear in mind is, you know, we are ahead of an election in the US. So part of this is definitely a signal to the electorate that the Biden White House wants to be as tough as Donald Trump, maybe even tougher, because these are higher tariffs. He was talking about 60%. This is 100% tariffs on EVs, and of course other tariffs on things like solar as well. So definitely there's an eye towards November as well.
All right, Ed, thanks for that. Some other business news stories for you now. And the FTSE 100 mining giant Anglo American said today it will break itself up. The move means that Anglo will sell or demerge its 85% stake in De Beers, the world's biggest diamond miner. Anglo also plans to sell its thermal coal assets and will demerge its shareholding in Johannesburg-listed Anglo American Platinum. But the news comes a day after it emerged that Anglo, which will focus in future on its copper, iron ore and crop nutrient assets, has rejected an increased takeover proposal from its larger rival BHP, valuing it at £34 billion. Vodafone said this morning it expects the merger of its UK operations with those of Three to close around the end of this calendar year. The deal, first announced in June last year, is currently the subject of an investigation by the Competition and Markets Authority. Well, the news came as Vodafone reported a drop in pre-tax profits for the year to the end of March to €1.6 billion. That was down from €12.6 billion the previous year and reflected the sale of Vodafone Spain and Vodafone Italy, among other assets. The results were better than expected and the shares are currently ahead by nearly 3%. The gaming giant Flutter Entertainment saw losses widen in the first 3 months of the year after writing down the value of some of its assets. The owner of Paddy Power, Betfair and Sky Bet reported a net loss of $177 million for the 3 months to the end of March. That was up from one of $111 million in the same period last year, reflecting non-cash charges totalling $356 million. But the company, which will shortly switch its main stock market listing from London to New York, reported a 46% rise in underlying earnings as the number of its monthly players rose by 11% to 13.7 million. And the ferry operator DFDS said today it's investing €1 billion in 6 battery electric ships that will be deployed on the Dunkirk-Dover and Calais to Dover routes to carry passengers and freight. The Danish operator said the first 2 electric vessels will be in operation by 2030, with the rest expected to follow by 2035. It added that the relatively short distance between the UK and France made the routes optimal for electric ferry transport. Now, BMW's pension fund and the family behind the Swedish fashion giant H&M are among investors getting behind a new venture capital fund set up to back founders seeking to make an impact in sectors such as climate tech, energy, biotech, AI and health tech. The second fund from the Swedish venture capital firm Norsken closed today, having raised €320 million. That was more than the €250 million which Norsken, which was founded by Klarna's co-founder Niklas Adelbath, was seeking to raise. Well, joining me now is Agatha Freeman, the general partner at Norsken VT. Agatha, great to see you. I should say, actually, it's not pronounced Norsken in Sweden, is it?
Exactly. I'm still struggling to pronounce it myself. In Swedish, it's Nordic.
Nordic, right. Well, I'm sorry I didn't get that quite right. Now, it's been a tough 18 months for VC. Are you surprised how easily you've been able to raise this money and the levels of subscription?
I would say it definitely has been a tough time for VC at large, but I think there is a very different story when it comes to climate tech and impact investing. It's been very good years for impact investing specifically. We've seen impact investing grow tenfold over the last decade. We've seen better momentum than ever, and our oversubscribed fund is one of the proof points of that.
You've unearthed 3 unicorns to date with the last fund. That's businesses that have reached a valuation of $1 billion. But how's overall performance been in that first fund?
We fundamentally believe, and that's also what the numbers show, that impact equals alpha returns. That's what we sell towards our investors, that we believe that impact companies will be the ones that will outperform the market on average. We've seen that in the public data. If you study the data over the last 2 years where tech valuations were slashed, it's a little bit of a different story when it comes to climate tech and impact investing. We've seen the valuations not come down as aggressively as VC at large. And equally, of course, there are tremendous macro trends that are fueling this. And that's why more and more investors are waking up to the opportunity. And again, like our fund was a result of tremendous interest from LPs and institutions all over the world.
So why do you think valuations have held up with climate tech?
It's very simple because it's very, very strong underlying macro trends. The companies that we invest in, they're not creating your next photo sharing app or social network. The companies that we invest in are addressing fundamental needs, fundamental problems. How are we going to secure the future of food, our energy, et cetera, et cetera. So the macro trends are there to stay, and the market size is of course huge. And big opportunities equal also big problems equal big opportunities.
Now, I mentioned some of the verticals in the jargon that you're looking to invest in, but it sounds from what you're saying as though that the focus is very much, again, going to be on climate tech.
It is. Our fund is not exclusively focused on climate tech. We want to invest in the next impact unicorns, companies that have positive impact on people and planet. But in reality today, roughly 80% of the portfolio is in climate tech. And the reason for that is that we see great serial entrepreneurs when they're thinking about what's going to be the next company that I'm going to start? What is the legacy that I'm going to build? They're all gravitating towards energy because, again, that's the largest elephant in the room that needs to be addressed. So we see tremendous supply of talent going into the space and building companies of tomorrow.
And at what stage, roughly, will you be looking to invest?
We're early stage investor. We can go in as early as being the very, very first ticket.
So pre-seed then?
Pre-seed, but we can also be a later stage investor. So anywhere from pre-seed to Series B is our focus.
And the fact that you've raised more money than you were looking to originally, does that mean the size of the investments will be slightly larger?
It means we can support our founders for longer, and it also means that we can make a few additional investments and have a few more goals on the shot.
All right, Agatha, got to leave it there.
Yeah.
Agatha from Norsken. Try and get it right.
Thank you.
Good to see you. Thank you. Well, the wages and jobs data this morning sent the pound slightly lower on the foreign exchange market this morning. Sterling currently off very slightly against both the US dollar and the euro. Single currency more or less unchanged right now against the greenback. On the equity markets, last night's gains on Wall Street were followed by a somewhat mixed session in the Asia-Pacific market. Sydney was lower ahead of a budget statement, while the Nikkei recaptured the 38,000 landmark. That was despite some somewhat patchy results from Sony, it must be said. In Europe this morning, here's how stocks are trading currently. Again, a pretty mixed picture just now. Talking points today include the German pharma giant Bayer. Its shares up 1.5% in Frankfurt on the back of a trading update. Well, here in London, the FTSE 100 is currently a tenth of 1% higher just now. Again, it's pretty mixed trading. Burberry is the leading blue chip gainer ahead of tomorrow's results. Burberry 2.75% to the good just now. Vodafone, meanwhile, up 3.25% on its results. To the downside, there are a lot of company results out this morning. The Irish conglomerate DCC, probably one of the lesser-known companies in the FTSE. That one's off 4%, again on results. Outside the FTSE, company whose CEO we've had on the programme quite a few times of late, Currys. Shares are up 9.5% after it unexpectedly raised its full-year profits forecast. That has sent up its rival AO World 5% in sympathy. As for the oil price, it's had a pretty quiet session so far. A barrel of Brent crude currently changing hands at $83.41 a barrel. It's up very slightly on the session. Well, with me this morning is John Wynne-Evans. He's head of investment strategy at Investec. John, great to see you this morning. Got to start, I guess, with Anglo American, the great big mining company. Interesting news. It hasn't really affected the share price today.
No, it hasn't. Well, obviously, the share price had already gone up quite a long way on the approach from BHP, the potential to make a bid for it, which it hasn't actually made. And then it came back with a second higher offer, about 13 or 14% higher, which was also rejected. And today at Bank of America's conference that they're having on the industry, they've unveiled some kind of potential restructuring plans of their own. But I think they're kind of, executing those restructuring plans will be rather difficult, seeing as it's quite a big unscrambling of the business and it could take quite a long time.
It is. I mean, what happens to that stake in De Beers in particular? I mean, the minority shareholder, of course, is the government of Botswana. Presumably they will want to say on what happens to that shareholding.
I'm sure the politics will have quite a big say on what goes on in terms of those disposals, yes, and whether there'll be trade disposals or whether they'll be separately demerged, I think still remains to be seen as well. But the De Beers business, our valuation potential for it is around about $7 billion. So, it's a big business as well. Then you've got the Platinum Group Metals business, which is about $8 billion. So they're the sort of lion's share of that. There's also a big metallurgical coal division, where I think it's about $6 billion. So, there's some big movements to be made there. And then you get left ultimately with a copper business and an iron ore business, which would be really pure, primary metals and a lot of exposure to the electrification in the future. So it'd be a much cleaner business. But, part of the problem is that Anglo's just been a mess for a long time and needs to sort itself out.
It has. What's really interesting, though, is that if it does all this, Anglo will look very much like the sort of business that BHP is hoping to eventually get hold of.
Yes, but the thing is, I think what BHP wanted was for Anglos to do all the sort of difficult getting your hands dirty stuff first, and then they'd come in and sort of pick off all the clean bits at the end. So Anglos are trying to sort of deliver that, by itself to shareholders, as it were. Maybe they won't get a control premium if that's the case, but it'll be a cleaner business and hopefully a more efficient and better growing business at the end of it.
Now, the other big corporate news in the FTSE this morning, of course, is Vodafone, one of the perennial disappointers in the index. What did you make of what they had to say today?
Well, the good news was they didn't actually disappoint today, so that's always a start. Yes, it's been a long, period of the chart moving from the sort of top left to the bottom right of the screen. And, the one thing that maybe has been a saving grace for it in the past has been the dividend. Obviously, the dividend yield keeps on going up, not because the dividend goes up, because the share price keeps going down. But they are going to be cutting that dividend next year. So even though at the moment it looks like it's got a yield of over 10% of it, which will keep for 2024, it's going to be sort of closer to 5 in 2025. Are they shrinking their way to greatness? Well, trying to, I would say, divesting of the Italian and Spanish businesses. Obviously, still some regulatory stuff to go through there. Maybe when Spain is gone, they'll be able to launch a share buyback of some variety, but that is yet to be announced too. And meanwhile, it's a difficult business. I mean, we all have our mobile phones. We love the, everything that comes with the networks, but, they're highly capital intensive. And unlike the sort of big platform businesses, in the States, which are very kind of low use of capital and make very, very high returns, once you're paying for the network, you're paying for the licenses, it's a very different business model, as it were.
Yeah, I mean, it's a really interesting point you made there. Can they shrink their way to growth? I mean, Aviva have kind of done this, completely different sector, of course. It's been a big story of disposals, but ultimately they are starting to grow beneath the surface again.
Yeah, I mean, there were signs of growth in today's numbers. I mean, I think the underlying revenues are up around about 7%. I think the EBITDA came in a little bit higher than expected, and also the attributable earnings came in a bit higher too, but that was down to a lower tax charge, for example. So it's sort of moving in the right direction. But it's still a highly competitive industry. Obviously, we're trying to shrink the 4 major players down to 3. That would be commensurate with some of the other markets around the world where you see greater profitability. But you've still got, the UK is only around about 20% of the business. The lion's share of it is still Germany. In fact, from the old Mannesmann deal back in 2000, that's almost 40% of the business, and that's got it's hard work of its own there as well. So. I think we've still got a long way to go on Vodafone to get excited about it.
OK, John, good to have you with us as ever. Thank you.
Okay.
Still to come here on Business Live. After years of pain following its devastating debt crisis, we'll hear how the Greek economy is surging with a boom in building. Stay with us.
I'm Greg Milam, and I'm Sky's Chief North of England correspondent. I've reported from around the world and around the UK.
I'm Mark Stone, I'm Sky's US correspondent based here in Washington, DC. And beyond the United States, from across the world, I report on the biggest stories.
I'm Stuart Ramsey, and I'm Sky's Chief Correspondent.
I'm David Blevins, and I'm Sky's Senior Ireland Correspondent. I remember some of the worst of the violence here.
I'm Alex Crawford, and I'm Sky's Special Correspondent based in Istanbul.
Welcome back. Those who remember its debt crisis of 2009 may be surprised to learn that in recent years, Greece has been one of the strongest performers in the Eurozone, which has led to a surge of fresh investment in the country. Well, symbolic of that confidence is the Ellinikon, which at €8 billion is currently Europe's largest urban development project, being built on the site of the old Ellinikon International Airport. It includes Greece's first skyscraper, the world's largest coastal park, 3 luxury hotels, a casino, super yacht marina, 8,000 new homes, and Europe's largest shopping mall. Well, joining me now from the development is Odysseus Athanasiou. He's Chief Executive of Lambda Development. Odysseus, good to see you this morning. When is all this due to be completed?
The first phase is expected to be completed at the end of 26, 27, and this includes all the coastline. We're talking about a 4-kilometer coastline with more than 1 kilometer sandy beach, and sitting on which we're going to have about 300 apartments and villas. The first, as you said, the high-rise tower of 200 meters, a revamped marina, gallerias, and the first in Europe integrated resort casino. Apart from this, we're going to have completed the 1/3 of the park, This is going to be the largest coastal park in Europe. We're going to have sports facilities, medical venues, and education. So it's a 15-minute city. We call it a zip code paradise, and I think we do not exaggerate.
Now, you've just unveiled today a number of new luxury residences at the development. Are these going to be targeted at local buyers or at international investors?
Actually, we launched the first luxury apartments about a year and a half ago, and our pre-sales and sales have gone amazingly well. We have sold everything we brought to the market. Now, recently, we brought another 500 apartments to the market. I wouldn't call them totally luxury. Probably it's mid to upscale apartments. And they also include some mid-scale apartments. Mid-scale meaning they start at about 400,000 euros for a, let's say, 60, 70 square meters apartments. And they go up, of course, to what you call the luxury apartments. Again, pre-sales are doing amazingly well. Everything we bring to the market is sold.
Obviously, countries like Portugal no longer have a golden visa for international investors. Greece still does. Is that helping stimulate interest?
Yes, to a certain extent, yes. And don't forget that the recent geopolitical developments come to enhance the existing demand from the East, meaning Egyptians, Lebanese, Israelis are buying apartments. You asked before about what is the percentage of Greek versus foreign buyers. We have about 25% foreign buyers when we started, and now this has gone up to 40%. And the West is also going to be a part of this as we start our international campaign this year, now that all the construction is visible everywhere.
Now, this is a colossal development. How have you financed it?
Yes, we're fully funded. We financed it through one rights issue about 3 years ago, 2 bond issues. We have locked also interest rates, and we're fully funded. The biggest part of the funding, thank God, is coming from these amazing pre-sales. We have already 700 million euros in our bank accounts, expect to be about 1 billion euros by the end of the year. Just to get a title on this, we haven't even gotten €1 of loans. Of course, we have credit lines, but we haven't used even €1 of them because of the exceptional performance of sales. And this project turned profitable for a project of this scale. I think this is impressive. Just 2.5 years after we got the shares, we reported a profit this last year in 2023. And by the way, apart from Ellinikon, Lambda owns some investment assets that are positioned very well.
I'm so sorry, we're out of time. I must call a halt there. Hope to see you again soon. Thanks for joining me.
Thank you.
That's it from me. Back at 4:30 this afternoon. Cheerio.